virtual webinar 2021 World Economic Outlook. It is my pleasure to welcome our speaker today, Ruben Nizar with Coface. He is one of the economists at Coface North America, and he will be discussing with us what's on the horizon. Also, of course, as usual, we will answer your questions. Please don't hesitate to use the chat box to submit questions during the presentation. As soon as Ruben is finished with his presentation, we will field all of the questions. With that, Ruben, please take it away. Thanks so much.
Well, thank you. Thank you, Anita. Thank you, everyone, for joining us this morning. I hope you're all safe and well. So yes, today the program is looking at the year ahead of us and what's at stake for 2021. So obviously, what is at stake in 2021 will be the recovery from the unprecedented shock that we experienced last year as a result of the COVID-19 pandemic. So you're all aware that because of the sudden stop that we all been through in the spring last year, the economy went to a grinding halt, and we experienced one of the worst contraction in economic activity at the global level since at least the Second World War. And what is quite interesting from this chart on the left-hand side is that you can see that it's far worse than the last recession, the Great Financial Crisis in 2008-2009. Another remarkable aspect of this crisis, and before I move on to 2021, is that it's truly a global crisis. As you can see from the right-hand side chart, most major economies have experienced full-year GDP contraction. At the global level, more than 80% of countries at the global level, so close to 150 countries, are estimated to have experienced these full-year contraction and a contraction in economic activity. So for 2021, we do expect the global economy to recover, and that will be something that is global. So you can see that in most countries that will be the case, including in China, which was one of the only major economy not to experience a full-year contraction. But what is also very important to note about the recovery in 2021 is that the level of activity that we will have by the end of 2021, according to these forecasts, is likely to be lower than the level of activity that we had prior to the COVID-19 crisis at the end of 2019. So why is that? Why will activity continue to be constrained? Well, the obvious answer to that question is that we'll have to continue to live with COVID-19 for a few months, and that it will continue to interfere with our day-to-day life. This is, we are experiencing it right now with the number of cases and deaths associated with the coronavirus being at record high at the global level, with new surges in the European Union and in Europe and North America especially. And we see that it is prompting many governments to implement new restrictions that is having an impact on economic activity. And so we had the good news with the vaccine, and vaccination campaigns have started in many countries and in most mature economies. But as you can see with the right-hand side chart, there's still a long way to go before we can achieve this herd immunity that will help us to move beyond COVID-19. So this is why, according to our scenario, in the first half of the year, there is a very high likelihood that we'll go through a stop and go scenario where major economies will have to tighten and ease restrictions to try to contain the spread of COVID-19. But one of the good news of these new lockdowns is that they will probably be less costly than the first lockdown that we experienced last spring, mostly in May and April. So as you can see from the left-hand side chart, mobility is definitely declining in countries that have experienced a rise in new cases and that have experienced an increased restrictions globally. But mobility was not as constrained as in April and May in many instances. And what is also very interesting about the second lockdown is that it is having more specifically an impact on some sectors. More specifically, service producing sectors seems to bear the brunt of these new restrictions. So hospitality is one of the sectors that is currently suffering the most from these new restrictions. Retail is suffering also a lot, as well as transport. So these sectors in the first half of the year, they will continue to feel the pain of the COVID-19 pandemic and will probably be the last to recover and will probably remain below their pre-pandemic levels for the foreseeable futures. And there was a lot of uncertainty regarding these sectors in terms of the recovery. But the good news is that when we look at factory activity, so on the right-hand side chart, you can see a survey of purchasing managers in major economies in the manufacturing sector. And you can see that in December, in some countries that have implemented tighter restrictions, while the recovery of the manufacturing sector continued. So this is suggested by the level of the PMI being above 50, indicating that we've seen month-on-month growth in manufacturing activity. So this is positive because it shows that the latest wave of and the latest round of restriction is not as costly and is sparing the manufacturing sector and is less disrupting also trade flows globally. So this is a relative good news that we have in this stop and go scenario for the first half of the year. But after the stop and go scenario, there is also some room for optimism. And part of this optimism can be fueled by record level of savings being accumulated, especially in mature economies. So in 2020, what happened is that consumption was disrupted because of the lockdown. And you can see that it had a huge impact on the personal savings of household that has surged in many economies. So here you have for UK, Canada, Germany, France, and the US on the left-hand side chart. And even though in the third quarter, when restrictions were eased in these countries, it went down, you can see that it's still above the level that we had prior to the crisis. So it suggests that this cushion of savings that have been built during the crisis might be used once we achieve this herd immunity and once everything starts to reopen for good. Well, many households will have the savings to spend, and this could provide a boost to the recovery in the second half of 2021. There are nonetheless two notes of cautions. So the first one is that typically after crisis, we've seen the level of personal savings remaining higher than they were prior to the crisis because households were more cautious with their savings and didn't want to find themselves in a difficult position as a result of uncertainty. So this is the first note of caution. The second note of caution is also there is a lot of inequalities in terms of these savings. Many households, and especially households that have been able to continue working with still working, have been able to continue to accumulate these savings. But this is not the case for all. And with unemployment rate expected to increase in many European countries, with unemployment being still very high in the United States and in Canada, we can expect that a lot of households will continue to suffer. And so it means that these consumption boost in the second half of the year will be mostly supported by one group, by one income group. So that's why government support measures are so critical. And you can see that it had a huge impact, notably in the US, in boosting income in April, for instance, when the CARES Act in the United States, the main piece of legislation that was passed in 2020 to support and stimulate the economy in response to the COVID-19 pandemic. Well, you can see that disposable income jumped by 15%, and it's been mostly supported by government social benefits to persons. With the new administration promising to continue on that front, we will see if it allows for this recovery to be sustained, and if it provides this income boost. But again, it is important to see if the inequalities in terms of which households have been hit by the crisis will have an impact in terms of consumption boost or not. The second thing that is important about 2021, and that will be very important for us as a trade credit insurer, is the behavior of insolvencies globally. So yes, last year, as a result of the worst crisis, we could have expected business insolvencies to increase exponentially. But on the contrary, what we've seen, and that's what you can see on the left-hand side chart, is that in most major economies, we've seen business insolvencies declining quite dramatically in 2020. So why is that? The reasonable assumption would be that in times of crisis, you would see business insolvency rise. But with in 2020, what we've seen is unprecedented level of support being given to and being considered to businesses to help them avoid these insolvency. So mainly what we've seen in most countries are guaranteed loans. Also, a measure that have been very successful according to our research so far are follow scheme that have been widespread in Europe to make sure that a company can decrease their costs in terms of personnel, but at the same time ensuring that people continue to receive income. So it has helped a lot to avoid a surge in bankruptcy in 2020. Also, this is worth noting, in many European countries, including France, Germany, the UK, we've seen insolvency procedures and bankruptcy codes being amended to give some more room for breathing to businesses. So it has helped to avoid the surge in bankruptcy. But in 2021, we could face a year of, we could see an increase with these measures. With these measures expected to wane off, with government support is probably going to be decreased over 2021. It is likely that we will see a rise in business bankruptcy at the global level. In the US also, that will be the case, where we can expect that many businesses will file for bankruptcies after we've seen a surge of 33% in Chapter 11 proceedings. So restructuring proceedings have surged in 2020, and it could translate into further liquidations in 2021, fueling a wave of bankruptcy in 2021. So that's something that we need to monitor very closely. And even though the economic outlook is improving in terms of bankruptcy, that could be a difficult year for businesses. Another thing we will be monitoring is the level of debt. With very low borrowing costs and considering the shock on liquidity and the need for liquidity that many businesses had, it has further fueled non-financial corporate debt. And we have already seen in the past that it is causing some new issues, and most notably the rise of zombie companies. These companies that are struggling to service that debt, but yet continue to exist. So that's also something that we will be monitoring very closely, especially in maturing economies, and in the medium term. That will be especially the case if there is if the growth levels are not sustained after 2021. Another key topic of 2021 will be Brexit. As you know, in 2016, the UK voted to leave the European Union, And after 4 years of very difficult negotiations, the Brexit is finally effective. There was a very important deadline on December 31st, because that was the date when the UK and the EU had to agree on a trade deal to avoid going back to what the World Trade Organization term that would have had a very deep impact and would have on trade between the UK and the EU. Fortunately, right before Christmas on December 24th, the UK and the EU announced a trade deal that will allow trade between the two blocs to remain mostly tariff-free and quota-free. But does it mean that there will be no friction at all in terms of trade between the UK and the EU? Well, not exactly. Some of the changes include higher level of share of local components that can make accessing these tariff-free standards more difficult to achieve. Administrative procedures and border checks will also be implemented starting January 1st in the EU and starting July in the UK. And so it will cause some frictions. Another key change with the UK out of the EU is that the services are only very little covered by this new agreement. So we'll see. So this is definitely a good news for Europe as a whole and for activity in Europe, because we won't see the disruption of a hard Brexit in 2021. But again, there will be some disruptions. And now, what is also important in terms of Brexit is that the UK has now the sovereignty to negotiate new trade deals. So it has found some trade deals, and it has found about 30 trade deals outside the EU at this stage to allow to continue at preferential standards, but there are still some negotiations ongoing, including with the US, and trade negotiations between the UK and the US has been slow in recent months because of the change of administration in the US that has slowed the process. And the last round of negotiation was in September. We do expect this negotiation to resume this year, but we will probably have to wait until mid-year before anything substantial is being announced, because the priority for both the UK and the US at present time is obviously containing the pandemic and its economic cost domestically. Moving on to emerging economies. So what is interesting about emerging economies is that we've seen a very uneven path, and we'll see a very uneven path for the recovery. So looking first at countries that have weathered the crisis quite well. So in these categories of country, we find mostly some Asian economies that have been able to contain the pandemic quite early, including Vietnam, China, Bangladesh, Myanmar, and that were able to restart their industries and to boost exports quite soon in 2020. So the cost of the pandemic was not as heavy as in some other countries. So this is the first categories of country that we see as weathering the crisis quite well. And we also find in these categories of country some countries that were doing well prior to the crisis, including some very fast-growing African economies, including Rwanda and Cote d'Ivoire. There is an interesting case with Guyana that you can see is one of the countries that experienced and that is expected to recover the most strongly from the COVID-19 pandemic. But for Guyana, it's related to the new production of oil. But the case of Guyana is quite unique, because when you look at countries that have suffered the most from the crisis and that are expected to continue suffering in 2021, we mostly find oil-producing countries. So you can see that at the bottom of these charts, we can find Venezuela and Libya. So two oil-producing countries that have been already struggling prior to the crisis, and obviously the crisis has been exacerbated by the COVID-19 pandemic. But we can also add to this list of oil-producing countries, commodity exporting countries, Equatorial Guinea, Congo, Brazzaville. These are also countries that, because of the impact on commodities prices and more prominently on oil, are at the bottom of the chart and are expected to be continue to operate at subpar level in 2021. In these categories of country, we also find, interestingly, most of the countries that have suffered sovereign debt crises. So more prominently in this list, there is Argentina, but we also find Belize, the Bahamas, and Suriname. So these are countries that have experienced sovereign debt crisis in 2020 and that have exacerbated their woes, and it will delay the recovery because at the time of the recovery, they might need to implement very harsh austerity measures that will weigh on the recovery. And sovereign risks will be one of the two key risks that we will monitor in general for emerging economies in 2021. As you can see, as a result of the 2021 pandemic, the government interest expense as percentage of government revenue is increasing in emerging markets. And it comes in sharp contrast to what we see in advanced economies, where very accommodative monetary policy stance is pushing government interest expense lower despite debt going higher. But in an emerging market, this is a concern, and the concern is twofold. So the first concern is, of course, a full-blown debt crisis, just like I've mentioned with Argentina, Lebanon, Belize, etc. And this could be the case for some countries in Africa that have seen a huge buildup in debt in the last decade. And I'm thinking more specifically about Ghana or Kenya, for instance. That could also be the case for countries in Asia, with Sri Lanka and Pakistan having to pay very high level of interest this year and could face a default. But the second, there is also a second effect, is that many countries in many emerging countries will have issues with their public finances, and that will push them in austerity at a time of recovery. So it might delay the recovery. And I'm thinking more prominently to two big emerging markets here, which are Brazil and South Africa. Plus, one of the issue is that these austerity measures might fuel some social discontent and increase political risks in these countries. And when we look at the impact of the COVID-19 crisis, both on the economy and on the overall population, with our day-to-day life being interfered and a very heavy human toll, it is also going to fuel a lot of frustrations and might increase the risk of political risks, especially in emerging markets. At Coface, we have an in-house political risk model to try to identify these social frustrations. And that's on the left-hand side, what you can see on the vertical axis. So from 0 to 100%, we try to identify using socioeconomic indicators, including the unemployment rate, inflation, the growth in income per capita, trying to see which countries are more prone to political and social disruptions in the year going forward. And when we cross these results with the toll of the COVID-19 pandemic, you can see with the countries in the upper right corner, the countries that are, in our opinion, more at risk. So in these categories of country, we find Brazil and South Africa that I mentioned, but we also find Mexico, Colombia, and Peru that might be at risks in 2021. So you can see that Latin America might be in the future one of the key regions to watch going forward. We'll also continue to watch the Middle East and Africa. You can see that Saudi Arabia, Morocco are also at risk according to this analysis. So these are, in short, our view for emerging markets in general. But when speaking of emerging markets, it is difficult not to mention China, which to some extent is not really a typical emerging market. And China is a very interesting example and a very interesting case, because it is one of the only major economies to have experienced growth in 2020, a full year GDP growth in 2020, because it was able to recover quite fast. So how did China recover that fast? So there are no big big secret that they cracked. Mostly they had the pandemic earlier, and they had very strict containment measures earlier, and they were able to contain the pandemic. So that's how they managed to restart activity from March, and you can see that activity has almost grown without any interruption since March in China, and it has been supported by very important policy stimulus by the authority, and it has notably helped to support recovery in investment, in fixed asset investment, especially in residential construction. So that's something that has supported this recovery. Another key aspect of the recovery has been trade. And more prominently, the recovery has been helped by exports of pandemic-related products, and exports of PPE have surged in China in 2020 and have helped to support the recovery. In 2021, we do expect that the economy will grow quite strongly, according to our scenario, 7.5% growth in 2021. And after it experienced one of the lowest growth rates in China history since the end of the Mao years, so more than 4 years ago. So this is quite an interesting story in China, because this is, at this stage, one of the only country that can boast having a V-shaped recovery, even though we're seeing lately that there's been some more cases in some regions around Beijing, and so they are also very much at risk of this stop-and-go scenario that I was mentioning before. With China, there is also another key topic that we will be following in 2021, and this will be the trade war. With the change of administration in the US, that will definitely be one of the key topics. But according to us and according to Coface, we don't expect these trade tensions to disappear overnight. There are still, Joe Biden during his campaign has mentioned that he wanted to address some of the some issues that he has with trade practice in China, including intellectual property protection, including national security concerns, especially when it comes to the tech sector. So these are issues that will continue to fuel some trade tensions between the US and China. Plus, Joe Biden has already announced that he does not plan to decrease tariff rates over the border between China. And as you can see, they are expected to remain quite high at around 20% between the two countries, far higher than the 5% average that we had in January 2018 at the very beginning of the trade war. And one of the key metrics that we will be following in the months forward is, what about this phase one deal that was signed last year? Just as a reminder, in January 2020, the US and China signed a phase one deal and China committed to purchase about 200 billion of US goods to try to address some of the Donald Trump's administration concerns. But as you can see from the chart on the left-hand side, it has failed to reach this commitment so far, and as of November, it has only reached 56% of this objective. So with the new US trade representative, so the appointee, Catherine Tai, is a specialist on China, we'll probably have to use this metric in the negotiations. And as you can see, this is going to be an issue, and it might be some very difficult negotiations in 2021. So we don't really expect meaningful reduction in tariffs, even though the tone and the rhetoric might de-escalate some tensions. So to conclude here, I would like to show you our country risk assessments map. So on a quarterly basis, Coface assesses the risk of business defaults in 162 countries using a model of macroeconomic and financial data, using data on business environment, as well as our payment experience collected over our more than 70 years history. Obviously, as a result of the COVID-19 pandemic, we've seen business default risks increase. And as a result, you can see that there are no more countries in the very low category of business default risks. But going into 2021, the outlook is more favorable, and hopefully we will see this recovery be sustained, and we'll have some good news to share in the coming quarters. I thank you for the attention. We can now address your questions, if any.
Thank you, Ruben. Let's see if we have any questions. We don't have anything in the chat box, but we want to give everyone a minute or two. I'm sure there are some questions regarding certain spots around the world. So please go ahead, type your questions in the chat box, or you can also unmute yourself and ask your question verbally. We finished the presentation pretty quickly. We have plenty of time to answer all of your questions if you have any. No questions? Let's give it another minute.
Annetta, this is Nick. Hi, Annetta, this is Nick.
Hello.
Hi. Ruben, thank you for a great presentation, very informative and yes, very interesting at all. You touched briefly on Brexit and the UK and what's happening there. Can you give us a bit more insight? Do you think, it hasn't gone as smoothly as people think, or that's what we believe here in the UK? We still think there's a long way to go. COVID obviously hasn't helped the situation. We're hearing about long queues at the ports in the UK. Do you think it's going to get any better? And how does that affect the recovery, do you think?
So yeah, you're definitely right. The first months of the recovery might be difficult for the UK. So there's obviously the COVID-19 issue that is having very high proportion in the UK. But in terms of Brexit and the problem with this trade deal that has been found at the last minute between the UK and the EU is that it does take some time to implement new processes, especially at the border. So that's why the border checks at the UK level we'll have to wait for July for them to be fully implemented. So the first 6 months of trade there might be some hiccups and some difficulties, and that's why 2021 might be a year of transition, and there will be some frictions in trade between the EU and the UK as a result of the UK leaving the bloc, definitely. And it is affecting, yeah, it is affecting the scenario and we've long argued that friction in trades is having an impact on economic activity. So,
thank you. And one last question, strike observation, really. You went into about the solvencies, and they're reasonably stayed stable, and that is because of probably most of the government support. So really, I'm sitting here thinking this is the calm before the storm. Once the help is disappearing and people's patience run out and people are all chasing the nickels and dimes that they've been waiting for I think we're going to see like a swell of insolvencies. I think it's just the calm before the storm, in my opinion.
I definitely agree with that statement. There is definitely be more insolvency activity globally in 2021, and that will be a key point of attention.
Thank you. Yeah, great presentation. Thank you very much.
Thank you, Nick, and thank you, Ruben. We have one question here. Do you foresee corporate debt levels increasing or decreasing in the next year?
So I think that in 2020 we've seen a surge in borrowing because of low borrowing costs and the unprecedented liquidity needs that company had. We've seen, for instance, in the US, a record level of bonds being issued with more than 10 trillion in debt being issued. So this is definitely a key trend in 2020. In 2021, it is likely that we'll see a slowdown in the increase. So probably not a decline, but a slowdown in the increase. So first, in the first part of the year, it is likely that we will continue some companies taking some of the guaranteed loans offered by governments to try to weather the impact of the crisis, especially again in the first half of the year. And bond issuance, they are likely to stabilize a little bit and to go down, but overall corporate debt level, they are likely to continue to remain high and to potentially crawl back to crawl up slowly in 2021.
Thank you.
Aneta, I have a question. Ruben, thanks for the insight. It's Jan Ambergen here from International Flavors and Fragrances. I would like to have your comments on the following statement. Due to COVID and let's say the uncertainty of international trade flows and global integration, you might see more concentration on regional coordination between companies, affiliates of companies, instead of the pure globalization we have seen over the last 10 years. And everything related to COVID, everything related to trade tariffs, simply the global uncertainty. Any thoughts, any discussions in Coface regarding those type of long-term movements?
Yeah, so we've seen in the past, in terms of globalization and deglobalization, in the past 150 years, if you take the long view, we've seen cycles. And definitely what we've seen, especially in the past 5 years or so, is a trend towards more concentration, calls for regionalization and reshoring. So this is definitely something that has been accelerated by the trade war. We've seen a lot of companies trying to reassess their supply chains as a result of the increase in tariffs between the US and China. So this is definitely something that has been exacerbated by the COVID-19 pandemic and with the supply chain disruption that we've seen in 2020. So we've published a paper back in July on this topic and on the topic of deglobalization. And even though we think that there will be a push by authorities to try to reshore industrial production, etc., we think that there will be limited success, because what we've seen over the past 3 years is that we now have a very complex web of globalization that is very difficult to untangle. and so there might be some limited reshoring, and the trend would definitely be towards less of a global perspective, but still it will be very difficult to just go back to a full reshoring or to widespread reshoring of activity especially in mature markets.
Okay, thank you.
Do we have any other questions? Again, you can type them out. Here it comes. Ruben, thank you for the presentation. Which countries in Latin America will likely bounce back first? And if so, what could the drivers, given the deep liquidity constraints in some countries and fragile political situation? So which countries will bounce back first in Latin America, and what are the drivers?
So I've mentioned Guyana, which is a very unique case because of the oil discovery and the start of oil production offshore. So this will be one of the countries that will probably bounce back faster. When we look at the countries that have, we know that some countries are going to lag the recovery. So we already know that for Argentina, Ecuador, that's going to be difficult. Brazil, we already know that there are some fiscal constraints that means that there will not be a lot of fiscal support. So Brazil might be difficult. So when we have all that in mind, what countries remain are facing a more favorable outlook, especially I think that they're mostly in South America. I think that, for instance, Chile is doing a little bit better and is having some better prospect. I think that Paraguay, to some extent, is not as is likely to recover a bit faster as well. So Chile, Paraguay will probably be my answer.
Thank you. Any other questions? Let's give it a minute. Again, chat box or just unmute yourself and speak up.
Yeah, hi, it's Nicolas here from Lily Export in Geneva. Hi, Ruben, and thanks very much for this presentation. Very useful, and unfortunately, I could not join right from the beginning, so maybe you touch base on my following question already, and I apologize for that. But Ruben, do you think that there are some industries that are going to be, hit more badly than other industry, or the other way around? Do you think there are industries which might not be hit as hard as other industries?
So in terms of sectors, what I mentioned is that service producing and personal servicing sectors are probably going to continue to lag the recovery in 2021. Among these sectors, we will mostly find the hospitality and leisure sectors. We will mostly find transportation sector. Transport and logistics will continue to face some difficulties in 2021. I think that another sector that we can add to this list, and especially in the first year of in the first half of the year, and as long as consumption is disrupted by restrictions, this is retail. Retail is also something that we'll be looking at very cautiously. We have mixed opinions on the automotive sector. There is still some cause for caution on that sector. We're seeing heavier regulations and environmental standards that were already taking a toll on that sector. With the sudden stop in activity last year, it has definitely suffered a lot. There was initially a strong recovery, but it has since slowed quite dramatically. So the year for the automotive sector in Europe and in North America could be difficult. So I would say these four sectors are at risks. Some sectors could improve. We've seen that the construction sector has been doing quite well, especially in the residential segment. So that's something positive, and we'll have to see if with low mortgage rates globally, the momentum is sustained. So that's one of the sector doing well. We'll have to see if the recovery in commodity prices is also sustained, and that would be beneficial for the metal sector. So this is one of the sector where there might be some positive news going forward, but we have to remain cautious because it's still early in the recovery process.
Okay. Yeah. Thanks. Thank you, Ruben. Thanks.
Thank you. Do we have any other questions? Thank you, Ruben, for the great insights. With the expectation V-shaped recovery, I guess with the expected V-shaped recovery in China, can you share your view on the recovery in Asia Pacific, like Singapore and other countries?
So overall, our scenario for Asia Pacific is quite good. We do expect a recovery that will be mostly supported by the industrial sector and exports in many countries. So in many Southeast Asian countries, especially including Singapore, we've seen that, for instance, Bangladesh, Myanmar, Vietnam were already forecasted to be among the best performing recovering emerging markets. Singapore is one of the countries that is also doing better. We're more cautious on some other Asian countries, and especially in South Asia, including India, Pakistan, Sri Lanka, because we've seen the COVID-19 taking a heavy toll. There are some issues in terms of public finance. So in the banking system in India is very fragile, and it continues to be an issue that we need monitoring, and especially with the level of debt and the level of debt of the public, it might crowd out private debt. So it might raise interest rates for private companies in India. So I'd say that these are the overall trends for these countries. But overall, Asia Pacific, they've recovered slightly better in the emerging world so far, and they are expected to do better in 2021.
Thank you. And let's see, 1 more minute for final questions, either in the chat box or just unmute. Nobody? Okay, then we can go ahead and close the webinar. Ruben, one more time, thank you very much for your contribution. We appreciate your insights and look forward to hearing from you again in 2021. Everybody, please stay safe, and I hope to see you on Zoom for now. Very shortly, we have another webinar coming up tomorrow, and we have quite a few in the coming weeks. Don't forget the virtual coffee chat, which is on February the 4th, where we have an open discussion with members, mostly corporates, asking questions and sharing information with each other, figuring out how to address common challenges with our panelists and with everybody who is participating in the virtual coffee chat. It is free for our members, so please do sign up, and let's stay engaged and let's stay connected as much as we can. And I really, really hope to see everyone in person in October in Europe and in November in the US. So with that, have a wonderful day. Stay well. Thanks again, Ruben, and we'll see you soon. Bye-bye.
Thank you. Bye.
Thank you.